Recording. Thank you again for all the participants, that have joined us. My name is Steve Fox. I'm the Chief Marketing Officer at OptionHotline.com. Looks like we have a good number of participants, so we appreciate all of you joining us. We're going to start the webinar in just about a minute. And first and foremost, I want to also mention our disclaimer, and please have a look before we begin sharing our website with you, and then Keith will take over. But we do ask you to read this disclaimer thoroughly, and we will get going right after that. Okay, we're just about ready to go. Keith, are you with us?
Yeah, Steve, I think I am.
Okay, tell you what, I will stop my share and take it away.
Perfect. Let me take over my screen share here if I can find the right button. All right. And it looks like we're recording and everything looks good there. Before I start, for those that are here, please feel free at any time to throw questions into either the chat box or the Q&A. If the question seems particularly relevant right at the time, I'll try to answer it in line. If not, we'll definitely make sure that we circle back to it at the end and do our best to get you the information you need. I titled this presentation, "What Trades I'm Looking at Today," and I think that's probably not named right. It's actually what trades I'm looking at tomorrow. So we look at these charts throughout the day, and I got to be honest, I didn't do much today. But a lot of the stuff that I saw today is really setting up some interesting stuff for tomorrow. So in hindsight, or for next time, maybe I should name this chat "What Trades I'm Looking at Tomorrow," so that you all understand that this is really all about getting set up for the next trading day. Before I get into it, here are my disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please do take just a moment to read through this before we get into the good stuff. My lawyers say I have to give you guys a moment to read through this so that you understand everything about this is educational. All right. With that in mind, let's get to me first, and then the ridiculous amount of content I'm going to try to cover today in my 30 to 45 minutes. First off, me, for those of you that are not familiar with me, I started on the CBOE back in 2005. I am a more analytical trader, I think, than a lot. I was a math major in college, like theoretical math, not, like just what's 3 + 7. I was doing proofs of theories and all that other good stuff. So very math focused. Got my MBA at the University of Chicago, graduate with honors there, statistics and econometrics, entrepreneurship, analytic finance. So very much I try to take numbers and make sense of what I see in the markets. I think that's the best way that I can understand it, because I understand numbers a hell of a lot better than I understand a lot of the other stuff going on in the markets. I am not a fundamentals guy. I understand patterns, and that's why technical trading makes sense to me. So I combine now options with technical trading to try to generate explosive return profiles. And that's what I do. So a little different from maybe the intro you've heard of me before, but with that combo, I started Trade Academy back in 2017. I joined Option Hotline in 2018. I'm the chief option strategist. And what we do is try to take these reliable technical signals and reliable options analysis to generate explosive return profiles in options and give that back to the people. Because when I was a market maker, all we did was try to take advantage of retail traders, and I don't like that feeling. I'd rather take advantage of the institutions. And maybe that's why, the GameStop bubble occurred, to try to take back from those that have been taking advantage of the little guy for so many years. So a reminder, if you ever have to leave early from any of my webinars, you can always email me or call me. Email is usually more reliable, only because sometimes I might be on another call. But I'll give you my phone number anyway. There's my email. We can schedule a call via email, and make sure that you whitelist optionhotline.com. I think Steve mentioned how to do that at the beginning. If you missed that, he'll show you how to do it again at the end. Webinars at optionhotline.com is going to send that free giveaway just so that you make sure you've got that, as well as the replay of the webinar we're doing today. All right, so what we're going to discuss today is basically everything. So there's a lot today, but I want to focus on a couple of particular swing trade technical setups that I'm looking at today, what I'm looking at for trend trading technical setups that I'm looking at today. I always do the why I use options, why volatility matters stuff in the middle, and I'm going to try to give a little spin to that today just because it's a little different given the current market environment. How I use options, so I'm going to tell you exactly how I use options, whether I'm swing trading or trend trading. And then finally, what sectors I'm focusing on for, sorry, that should say swing and trend trading, not swing and technical trading. Everything I do is technical, of course. So the swing trading setups that I'm looking at today, well, basically the market just dipped. For those that have been following along for the last few days, kind of looked like the market wanted to fall. I started seeing a lot of reports of people saying that, gosh, with how overbought we are technically and fundamentally, it's time for a major crash. When I see people saying that, it starts to tell me that everybody's betting on the major crash, so we're probably just going to get a minor dip. That seems to be what the market's telling me after today. We'll look at the charts to see if that can confirm it. There's two ways to play it. Usually when I see a little dip like that, I'm looking for a bounce back to previous highs. But in this case, I'm looking for new highs. And the reason is that we haven't spent much time at those previous highs. So we don't have a lot of resistance in the market. The market dip was shallow. There's a lot more leverage for playing for the bigger move to the upside. The move back to the previous highs was a play for, a week or a month ago, not this last few days. What is the swing trading setup that I'm looking for? It's either a flag or a pennant. So what you see is that the market had a consolidation period, which we had, then a breakout to the upside, which we had, then a pullback for a couple of days, which we just had, then a move back above the previous day high, which we just had, and now we're setting up for this potential move that could be explosive to the upside. So what causes this to be explosive? Well, number one, we have a bull market. I think that anybody that looks at any chart, even if you aren't a big chart follower, you would argue that we have a bull market. It's going upwards from the left to the right. That's a bull market. We've had massive returns overall in the stock market for over a year now. It's a bull market. Then we get a little bit of a period of profit taking. So we had some profit taking in the last few days, but this was just short-term profit taking. This was a matter of days. This is not a multi-week or multi-month profit taking like we had actually seen earlier in the year. So earlier in the year, we saw a lot of chop as people were trying to take profits. That set up a really good new trend move about a month ago. Right now, what we're seeing seems to be just that first rung of profit taking as a result of people saying that they got chopped up a lot in February and March, and they just didn't want to miss out on it on this move in April. So they did that. The problem is there's no resistance above us. There was basically very few people really taking that profit. I think there's a lot more people out there in the market trying to play the next leg. What can drive that next leg? Earnings. So everybody complains about that multiple. The PE multiple is massive. The other thing that could really trigger this is the stimulus. So we've got earnings where we're going to get the numbers that can change the PE multiple pretty quickly, because if earnings are high, that PE multiple drops, makes it look a little more reasonable. Stimulus means there's a lot more money in people's pockets, even if they're starting to just now get back to jobs. The economy got hit obviously with COVID, but as you start going back into your normal, job employment situation, you start feeling a little more confident about investing and trying to make money in the markets for either your retirement or just for playing around. A lot of people have been playing around since GameStop. I think those people are starting to get a little more serious now instead of just playing. So the GameStop move got a lot of people to play in the market. They started to realize that there's a lot of ways to make money, but a lot of ways to lose money. Now they start getting a little more serious. That creates a situation where people of many different, basically macroeconomic situation, or not macroeconomic, sorry, personal finance situations are still trying to make money in the markets, because we see this as the great way to leverage your finances. not getting the 0.5% you're going to get or less in a savings account, but trying to get that 8-9% average of the stock market or more in the recent years, and even more if you go into options. The stock market provides leverage and generally reliable returns in the long run for a diversified portfolio. Those that were buying into GameStop at $450 unfortunately had a bit of a loss here, looking to try to figure out, though, how to find the right answers. So we've actually created more people investing in the stock market, and that creates shallower dips when we get these initial bull flags like we just saw. So I'm looking for small pullbacks, then breakouts. That's kind of what the market gave me today. I'll show you some of the charts shortly. The first one being the S&P 500. So we saw this period of consolidation that I mentioned here in February and March. The market really didn't go anywhere here. So after the election, the S&P 500 really ran. Nice return up until about the beginning of February, and then we just chopped for a while. Broke out right around April 1st, and then the last couple of weeks just had a really nice run. It's a couple of weeks. It's enough to make people say, gosh, I made some good money here. I made a 4% return in 2 weeks. If the average return on a normal year is 8 or 9%, why wouldn't I take some money after 4% in 2 weeks? So that creates this little dip that we saw Monday, Tuesday. But lo and behold, today, we've now gotten some recovery here. The market is firm today. It looks like it wants to retest that high. And because there's not a lot of trade activity here at those highs, I expect this to be a breakout type move as opposed to a consolidation on the return. When we normally see those pullbacks after a long consolidation period, you get a little bit of a stall near the recent highs, which we saw kind of in the middle of March, then a pullback, and then you can go. In this case, because we've had such a strong move without much resistance, I'm looking for that next move to be firmer after this little minor dip. So that sets up my swing trades as well as my trend trades. So when I do a trend following signal, I use simple moving averages. Simple moving averages take the average closing price over a recent period. Common examples are the 10, 20, 50, 100, and 200-day simple moving average. I know there's a lot of numbers in there. The numbers themselves actually make very little sense. A 10-day moving average makes some sense because it is 2 weeks of trading, 5 days per week of trading, means 10-day simple moving average. That's good for me. 20 is really close to a month. We have on average 22 trading days per month. That makes sense to me. Then it starts getting kind of random. So 50-day moving average is effectively 2.5 months, 2.25 months. 100-day moving average is 4.5 months-ish. 200-day moving average is about 9 months. These don't make much sense other than the fact that people like round numbers. Round numbers make sense to people, so they use them. But at the end of the day, the idea is that if the current price is above your target moving average, it tells you that the bull is in control. And if we are below your target moving average, then the bear is in control. So when the stock price is above, say, the 20-day moving average, it means that over the last month, there has been generally bullish flow in the stock market. Why? Because the current price is higher than the average price for the last month. That means that the guy that's been buying continues to buy even as prices go up. And if we're below the 20-day moving average, it means that the guy that's selling is continuing to sell even though prices are going down. He's still willing to sell at current prices. So, if you have an asset that you're willing to sell for, $500, $400, or even $300, if you could sell your first one for $500, your second one for $490, your third one for $480, you're going to keep going until you get down to that price. You say, I don't want to sell anymore. That's what we're dealing with when we get a dip. We didn't get a big dip, meaning that most people seem to be saying, I'm willing to run through earnings season, see how things go, and I'm not sure I want to sell right now. That's a good bull flow for the market overall. And that's why that trend still exists in the S&P 500. Now, when I see the moving averages right now, yesterday was the first real attempt at getting the S&P 500 below the 10-day moving average here in purple. The green is 20, the blue is 50, the yellow is 100, the red's 200. So you can see that we're above all of them and firmly above the 10-day moving average once again today, with signs that people just still want to put their money in the market. So if people want to keep putting their money in the market, why would I fight that flow? That's what trend trading is all about. So my trend following signal is actually the triple moving average. By using a system that helps me define who is in control, I can identify what a stock's momentum looks like. So in my case, I use stuff that's a little bit more logical. So I use the 22-day moving average, which I mentioned is the average number of trading days in a month. So that's a 1 month moving average. What's the money flow been for the last month? That's the 22-day moving average. And it's a rolling period, of course. The 89-day moving average gives me 4 months. Now, the 148-day moving average may seem a little off. That's basically getting us close to a little over a 6-month moving average. So it's a 6 to 7 month moving average there. At the end of the day, this helps achieve that goal of looking to see who's in control. If the 22-day moving average is above the 89-day moving average, it means short-term money flow is positive. If the 89-day moving average is above the 148-day moving average, it means medium-term money flow is more positive even than the long-term. So basically all the signals into the market when the short term is above the medium term and the medium term is above the long term are telling me people are still buying. When we start getting all these things clustered together, it tells me people aren't sure what the direction is in the short term, medium term, or long term. But when they're stacked up nicely with the 22 above the 89, above the 148, it tells me every term is showing positive money flow. And right now, the money flow is pushing the stock higher. We're getting momentum again. So it's not just that people see this stock market going up, they still see value currently in the market. So when I compare those three moving averages to the S&P 500, you can see very clearly that basically since the end of October here, that stack has been perfect. In green, I have the 22-day moving average. In blue, I have the 89-day moving average. And in red, I have the 148-day moving average. So with the green above the blue above the red, I can generally be bullish on the market. You can get a dip right when you're going into a big fundamental input. For those of you that don't recall, at the end of October, we had this really big fundamental input called the election. So that was making people a little spooked. As soon as we got through the election, we started to recover. Then we got a COVID vaccine that created a spike. And then now it's just been relatively smooth sailing other than a little dip here at the beginning of March. Overall, the money flow is bullish. And because these moving averages continue to be stacked, it continues to give me confidence so that I can look to buy the dip in March. If we start seeing bigger falls than what we saw at the beginning of March, these moving averages will start to invert, create bigger problems for the market. Right now, we're just not seeing it. So my concern right now is, why would I want to sell? Well, I'd want to maybe take a little profit when we get way above those short-term moving averages, just because it means we're overbought, which is what we saw really last week. But it doesn't mean we're bearish. It just means that maybe we need to slow down a little bit before we get that next big run. Although, to be fair, we've been further above these short-term moving averages than we are. And when they're upward sloping like they are, you can see this 22-day moving average has risen from $390 at the beginning of the month all the way to $404 right now. So even if you get a dip back to that short-term moving average or medium-term moving average, it's going higher and higher every day. So you can say, gosh, $415 seems expensive today, but if we just sit at $415 for a week, all of a sudden those moving averages have caught up. It doesn't seem that expensive. Then we can get that next move. So I think that's part of why we got this little dip here, on top of the fact that we had a couple of maybe questionable earnings. But overall, things look pretty good. This stock market wants to go higher. So with that in mind, look, here's what I really do with this information is I go through a weekly list of trade candidates. So in the swing trades, I go through the technical formations, look for stuff that have a good bull pennant, bull flag. That's what I'm looking at right now, and look for ways to leverage that move to the upside. The average on my winning trades is over 200%. So that's a pretty good return. You can go to optionhotline.com/outlier to grab this report. It's pretty cheap. It's basically $1 a day. I'm sure you guys all spend $1 a day on something that seems meaningless, like a cup of coffee, which is probably $3 a day now. I also outline my trend trading candidates. These are the ones that I want to be buying and holding with longer holding periods under the assumption that the trend is going to continue, like we've seen in the S&P recently, not like we've seen in small caps. We'll come back to that chart later. The average on those is 160% profit on the open trades. Again, another really good system for us. One of our trend trading programs was up almost 150% for the year last year. And that's with holding a lot of cash in order to make sure that we're managing risk well. Risk management is the key to most trading systems. This just gives an introduction to how I'm looking at swing trades and trend trades so that you can understand my mentality. If you're interested in it, you should certainly email me or simply go to optionhotline.com/outlier to sign up. And with that, let me do my option conversation here, and then I might take a little break after this for a little glass of water. But the first thing I always talk about mentioning risk management is that options have risks. So there is increased transaction costs. It's just the way that the exchanges and the brokerage houses work. There are higher commissions and fees associated with options than there are with stock trades. There is assignment risk on short options positions. We're not going to worry about that today because I'm only doing long options for leverage. Decay. Options do decay in value over time, which we are going to worry about because I'm using long options. And finally, we have volatility. The value of options is partially and probably most importantly dictated by implied volatility. That's constantly changing, constantly questioned by the market. How much do we expect the market to move? And that's something that is probably best learned from being a market maker, which I did for years. Working at like the hedge fund that I worked at, the idea of implied volatility was not necessarily as important to them as the place they expected the stock or the future to go. In this case, I think implied volatility is the most important input to an option, and it tells me where the leverage really is. And we'll explain that here as we go through. So for those unfamiliar, this is a simple equity chart. It's very easy to understand. It's linear. If you buy $10,000 worth of stock and the stock goes up by 20%, you make 20% of $10,000, $2,000. If the stock goes down 10%, you lose 10% of $10,000, which is $1,000. Stop losses are a crucial element to any trading strategy. So if you told yourself you were going to get out of the stock if it went below 90, that's great and all, except for sometimes the stock has something like earnings or an FDA announcement or just a surprise announcement that drops the stock in half. That's dangerous. And so that's why $1,000 is technically what you think you're risking, but it can be a lot more. And I've seen it a lot more times. On the upside, of course, if things go your way, in theory, you have unlimited upside. So there's a reason to want to find something that defines the risk better and creates leverage. And that's where options kick in. So if I was thinking that I wanted to spend $1,000 on a trade idea, and I could buy a call option giving me the right but not the obligation to buy the stock for $100 anytime in the next month, that has value because it means I can buy the stock for $100 or less or more. Sorry, I can buy the stock for $100 or less in the next month. When can I buy it for less? If the stock goes below $100. If the stock goes above $100, I'll just buy it for $100. So that gives me a good entry point. Now, if I'm willing to risk $1,000, I can buy 2 of these calls because each call represents 100 shares. So at $5 times 100 shares, that's $500. If I want to risk 1,000, I can buy 2. That gives me greater upside and leverage, and also defines my risk to the downside. So that if the stock goes below 90, the most I can lose is still that $1,000 I paid for premium. I just won't exercise my calls. But if the stock goes to $120, I make 50% more money. Instead of making $2,000, 20%, I make $3,000. And in theory, you'd say, oh gosh, that's great. I'm making $3,000 on a $1,000 investment. That's a really nice return because at the same point, I have $9,000 in cash to diversify into other ideas. The downside is, of course, if I pick a stock that just doesn't move. If the stock doesn't move, I would have been better off in stock or cash. So that's why options and technical analysis combined make more sense. Because if I can predict that this stock has a good chance of moving way up, then my options leverage can pay off. But if I think this stock's only going to move up a little, then options analysis doesn't help me very much. So I first try to find the great technical setup and then make sure that the options make sense with that. To give you another way to look at it, think about it as the clearance rack at your local store. So you go out and you're looking to buy a pair of shoes. If everybody in the world wants to buy shoes, shoes get priced higher. There's no reason for them to go on sale. So I'm not going to get a good deal. But if nobody wants to buy shoes because shoes just haven't been selling, and all of a sudden people just haven't quite recognized that there's a new trend of buying shoes, the word trend there is intended. If there's a new trend to buy shoes that hasn't been existing, shoes still get cheap. And then I can buy them before anybody else does, before they get expensive. That's what implied volatility is. If there is no demand for shoes, then these shoes get cheap. If there's a lot of demand for shoes, they get expensive. Now, when I'm dealing with a call, I choose my strike based upon whether there is demand or no demand. When there is no demand, but I see demand coming, I want to buy an out-of-the-money call that gets me more leverage. I can buy almost twice as many shoes when I'm an early adapter to that. But if shoes are kind of expensive, I just don't want to pay up too much, but I know I need to get into some shoes. So I'm going to buy them for 5 or 10% more than the rest of the market is. So I'd rather pay 10% more when the trend already exists, or pay 50 or 60% less when the trend is just starting to form. That's the difference between swing trading and trend trading. When trend trading, I know that the market probably already knows that shoes are a good buy right now, and I'm probably paying a little too much. But because I expect the price of shoes to continue higher, I don't mind buying in under that expectation of continued higher movement. When nobody else has really recognized it yet, I want to get as much leverage as possible. That creates a very asymmetric return profile. Well, right now, the market's kind of telling us that they don't expect any of this stuff to move. Nobody really wants to buy right now. The VIX is near lows. Implied volatility at lows means generally option prices are low. So that means I've got leverage right now. Well, how do I deal with that? I basically do a comparative analysis. If implied volatility is low, more like this chart, I can get more leverage on those out of the money options. When implied volatility is high, I get more leverage just by being in the stock or in the money options where I can get some defined risk. We can zoom in here. This is for that out of the money option. This is that swing trading environment. If I think that this is a new trend forming, brand new explosive move, I want to swing trade with out of the money options. In this case, I have the $106 calls. This would be my sweet spot for making exponential type returns relative to the stock. Why? Because if this is something that's currently $100 and I think it can go up 20% in a month, you can see how much more leverage I get. And 20% sounds like a big number, but it depends upon the stock. This is just something that I put together depending on the expectation that this stock would normally move, what about 2.5 times 6? So around 10% in a month. So that means that $110 range looks like a break even no matter what the implied volatility is. And that makes sense. That's what we're seeing. This is a stock that we normally expect to move 10% in a month. If I think this could be a really volatile month, especially to the upside, I want to buy out of the money calls, especially when they're cheap. But when I see implied volatility at highs, not what we're normally seeing in the market right now, you can see that really I have a lot of work to do just to get to my break evens. I'm going to get to $115 just for all this stuff to make sense together. And even if I get to that 20% move, gosh, I don't make that much more money being long and out of the money call. I'd be better off just doing something like stock in purple or an in the money call in blue just to define my risk. So when implied volatility is low and I see a potential new trend forming, I want to get into an explosive move. When I see implied volatility high and I see a trend already existing, I'd rather only buy the $94 call so that I can define my risk to the downside and have a little bit of extra cash to try to leverage with similar types of trades. All right. Now, with that in mind, I'm going to reiterate the outlier watch list here. I have those swing trading candidates that I mentioned, 204% profit on winning trades on average. The trend trading candidates average 160% on open trades. Steve, I think you were going to give me a little bit of a breather here so I could get some water, and then we'll come back here in a minute to talk about current stuff I'm seeing.
Okay, very good. Thank you again, everyone who is participating right now. We have a nice group, and so thank you again for joining us. I'd like to welcome all of you again. Let you know that we are going to do a website tour again at the end of Keith's presentation. We did one at the beginning, but we did get a number of participants come in right at the last second who missed the website tour. So please stay on with us. Only takes about 2 or 3 minutes. Also, as Keith mentioned, but I'll mention again, if you do have any questions while Keith is presenting, please feel free to type them either in the Q&A or the chat box. And both Keith and I monitor them. Keith will make the decision if any of them are appropriate to stop and answer right at the moment. But otherwise, all of them will be answered by Keith right at the end of his presentation. And last but not least, for participating today, you will get an email tomorrow with a link to your free gift as a participant. This is the Keith's option trading checklist. Very handy tool when you're trading. And Keith is going to send you a link to that for free just for being a participant today. And that's going to be an excellent tool for you to use. So thank you again, all of you who have joined us. I think Keith probably has had his fill of water. Keith, you ready to jump back in?
Whew, yeah, I think I got my tongue
Great.
untied and I got my my water refill going. So,
all right.
With that in mind, let me just reiterate. Yeah, if you just go to optionhotline.com/outlier, that's where you go to sign up. I think we had a couple questions about that. So the link is down here in the bottom corner. I'll try to keep that up as we go through the rest of the presentation here. And again, if you do have questions, you should always feel free to email me. I'll have my email address back up at the end of the presentation, or when you check the replay, it'll be there at the beginning of the presentation as well. So how do I use options for these trending markets? I kind of mentioned it. I find a long entry that's in the bottom portion of a trend channel, but meets my triple moving average system. So these trend channels are formed. I'll try to draw them on some of them so that you guys can understand what we're looking at. And then I just structure my trade 3 to 5 months to expiration options. So they have some time. And then I use 65 to 80 delta options. So this means they're going to be in the money call options with a long time to expiration. This is going to allow me to work through some of that chop that occurs at times and still have that leverage to the upside. So it's all about being able to work through those consolidation periods and not needing the stock to move up every day. On the other hand, with swing trades, I need low implied volatility to get those options cheap. And I want to break out from a flag or a pennant like we're seeing right now. That's going to give me 1 month expiration or less with 30 delta options. And I'm going to tell you right now, the difference is I need these stocks to move and I need them to move now. So if we chop around for 2 weeks and then move, it may not be enough. I need these stocks to be timed very well. And when I do time them very well, I get explosive returns. I mean, we've had returns of 1,000% on trades. That's what you get when you time it perfectly. It's very hard to get that kind of return on a trend, but you get a lot higher percentage probability on a trend. So the swing trade is going to give me lower probability of success, but with much bigger hit returns. That's why I call it home run swing. It's the home run hitter of your portfolio. We're looking for somebody to hit, 280 with a lot of home runs, not Ichiro Suzuki trying to battle towards batting 400 with a lot of singles and doubles. I'm looking to bat a little bit lower on the batting average, but get huge return potential. It's very rare to see both high probability and massive returns. If you can get that, find the holy grail. In this case, we found a system that really helps create massive return profiles and helps really actually balance out a portfolio because it's a very cash heavy strategy. So what are we seeing right now in the markets? Well, let me get my handy dandy drawing tool so I can draw on here what I'm seeing. First off, the S&P 500 has a new trend forming. And we dipped. And it kind of went through the trend channel for the recent stuff. So the last 2 days were a little questionable for me. What does that mean? It means it got a little hairy. It means a lot of people are starting to say that this was going to be a bigger collapse. At the end of the day, this whole long consolidation period creates way too much support for us to have a collapse. Now, that might be down at $395, so we're talking about a 5% pull from here, but I don't think the downside is much more than 5%, and that upside trend that we just started to form looks a lot better. So this is what we see. When you have a trending market, you get a trend higher, like we saw basically since the election. Then we saw 2 months of consolidation. Now we can do a trend higher for a couple of months and then a couple months of consolidation. It's really hard to spike higher because, frankly, most of the time when you're in a bull market, nobody's really that worried about missing out anymore, unless you're in like, Doji coin or something like that. Right now, if everybody told me that they thought they were missing out on the market, I'd think we were close to a top. So right now, I like the S&P 500. You can see that trend, then consolidation, then potential for trend. This is a sector that I'm looking for trend trading candidates. And this sector is the overall stock market. So it means I'm looking to invest in the stock market with my longer term call options. Let's clear all these. And then we can switch over to the next sector, which is the NASDAQ. And we'll get our drawing tool once again. And you can see that there was a lighter trend here to start the year. It wasn't quite as steep. When the rest of the market was consolidating, we got, this, all over the place. We basically just chopped, okay? I'm going to clear all this because the focus now is really since April 1st. And we had the same exact breakout type move, new trend, and 2 days of pullback. If I were to look for a target zone on a break, it'd be around $320. Again, that's not a huge move for the tech sector. We're talking about maybe $15, which is 4 to 5%. So the downside is 4 to 5% with that potential for great new upside, especially since just a few days ago, we made a brand new high in tech. Tech had been kind of forgotten since the election. So when the election came, everybody moved to this sector, the Russell 2000. Just look at the move that we had from November 9th. That was the COVID vaccine day, up until, again, the middle of February. Just an absolutely incredible move. We're talking about from, call it $175 in the Russell up to $225, $50, 30% in a matter of 3 months. That's a lot. I mean, for an overall macro index to move 30% up in 3 months and not coming from the 2009 lows during the subprime crisis or something like that, that's a big move. It tells you that there was some big market rotation. That created a longer term of consolidation that we're still seeing right now in small caps. Until we see a new high, this is that choppy market. So this can be traded short term, trying to buy near that lower part and sell the upper part and buy the low and sell the high, or it can be ignored and wait for a move out of this rectangle that's been going since February 16th, call it. We have had a range from about, call it $215 to $235. It's not that exciting. That's still an 8% range. That's good, but it's not that exciting relative to what the other trends are, and it's not as reliable. So for me, small caps are actually turning into the more boring sector after being the exciting sector for 3 months after the election. So there is a question here. There seems to be an inflection point at which you pick a low volatility trade idea that you think will explode higher. Yeah, so the question is, does the service offer trade signals that match an explosive chart pattern on low volatility, et cetera? Absolutely. So that is the ultimate goal with everything that I'm looking at, is trying to match low volatility with an explosive move. If I see both, I hit the jackpot. If I see one and not the other, it means I can hit a double. So, it's the fastball down the middle is, the low volatility with an explosive chart setup. That's just, swing for the fences. Right now in small caps, I don't see that setup. So for me, even if small cap volatility gets low, I'm looking at chopping the trade. It's just about trading this little range or finding a sector that has more to it. For me, it's more about finding a sector that has more to it. Let's talk about what's really driving tech. Traditionally, it's semiconductors. So for you looking for individual names, which is what I traditionally do, I start at the big sector, the big ETFs, and then I break it down into the subsectors and then all the way down to the individual names. In semiconductors, we're just starting to see some signs of recovery, but let's look at those moving averages. I mean, the 10 is above the 20, is above the 50, is above the 100, is above the 200. So we're starting to see that stack look good for the last few weeks, but the price action is still kind of in the middle there. So there's something, it seems like the market wants to get bullish here, but is struggling to do so. And again, if I draw out these trends, yeah, there's a clear bull trend after the election. It ended earlier than a lot of other sectors before February even started. And then we had chop, chop, chop. I'm not even going to bother with the two lines. We're just literally going up and down, flat, down. There's nothing here that looks like a pattern. So when you're looking for pattern recognition, if you tell me you see a really good, reliable pattern here, please contact me via email so that we can figure out exactly how to leverage that. For me, this is just a complete random walk. This is a dog walking back and forth across the sidewalk, looking at squirrels and fire extinguishers and other dogs. And oh, good, there's a leaf. There's nothing here. So that makes it a little bit tougher to understand the ultimate signal in tech until we get back above here. So we did have a consolidation period in tech. We did have a stall point. If semiconductors get above 200 and call it $60 and tech looks bullish, this could be a sign that tech is really starting that big new trend. So I mentioned before, when I looked at tech, I thought this could start to get a breakout, and it's starting to get a little bit of a trend here from some biotechs and things, but it's really not showing yet in semiconductors. So until semiconductors get that move, I'm a little bit questionable about tech on the whole. I can still find names within tech that are going to perform well by saying, okay, I don't need to buy the NVIDIAs, the AMDs, the Qualcomms, and the Intels. I can focus on the Apples or the Microsofts or the IBMs. They can still be in tech. They just don't necessarily want to be in semiconductors until I see a clean move in semiconductors. So for semiconductors, I don't have the leverage. For the individual other names, I do have the leverage because of that low VIX. Does it start to make sense here where we're starting to see this like, okay, there's explosiveness here, but not everywhere? That's great for the market. If I see explosive moves everywhere, it means we're probably pretty close to a high. I'm happy to see low probability, smallish type moves in a number of sectors. That tells me the market is still somewhat balanced, going through rotation and looking for opportunity as opposed to just buy everything and just you're going to make a ton of money. That's not actually a good market setup. That's not a healthy market if you can buy everything. Another sector that's been really interesting to me is oil. Now, I'm not going to bother with the trend channels here. You can see them. I mean, from November 23rd all the way up till almost March 15th, oil was basically in a straight line up. We chopped around a lot. But you can see here, if you're really looking at my moving average lines, and this is the reason I have them on my charts, that the 50-day moving average has provided really good support in oil prices. That's interesting to me. So this is why I look at moving averages. They tend to provide support too. So that 2-month price point is kind of the price where people are starting to buy that dip. Now, we're not quite clear on the 10-day, 20-day, 50-day, 100-day, 200-day, all that, that moving average, triple moving average system, but we're really close to getting a resolution to that. If oil can start to recover over the coming days and test those recent highs, which are about 4 or 5% away, again, a much more volatile ETF than some of the others, then we could start seeing new highs in oil. That could be an interesting play in oil, or it could be a much more interesting play in oil services. Oil services tend to be highly correlated to oil. And there's a big if oil can resume its uptrend, oil services could very, very much have a lot of leverage to the upside. You're looking at an ETF that is trading about $60 off of its previous high. so about 25%, while oil itself is kind of towing pretty close to the previous high. And you can see that in the middle of March, OIH was trading around $230 the same day that USO made its high. So if USO, the oil ETF, goes back to a new high, why shouldn't OIH recover with it? This is a little bit of a correlations trade, but what I'm looking for now is some signals that money flow is going to go back into those oil services. So if I see that bull pennant start to play out, and this is a big one, it's kind of a longer one. If I start to see this downtrend line starting to break out, this gets me that much more excited about the upside leverage here for a swing trade. I don't know if it's going to turn into a trend like it did back in November, but you can see this is a sector that has a harder time holding long-term trends because you have a lot of dips. So I want to leverage the breakout from that dip. This is one of my favorite sectors, to be honest. I think OIH has a lot of potential to the upside if oil can find firmness. Now, I think I have 2 or 3 more sectors here that I want to cover. First is financials. Financials have been a big benefactor, again, of the COVID vaccine and the election. You can just literally see this is a really nice, clean upslope here. Financials are trading right around $27. Now they're trading around 35. Lower percentage, but also lower implied volatility. So you get that leverage by buying options still in this sector. It's just that they're cheaper because the moves tend to be expected to be lower. The big driver of this has been bonds. When bond yields go up, people expect financials to do well because they get financial companies tend to do better when they can get a spread between government bonds and individuals like me and you with our 30-year mortgages. So this is a 30-year treasury bond yield. There's been a big move from low 2s all the way up almost close to 3%. By the way, for those that don't remember, a couple of years ago when this number hit 3%, that got real scary for the market. Right now, it's getting a little bit of a pullback. That could signify a little bit of a move away from financials. So financials have held up okay for now. I don't think that the move to here is a problem for financials, but if we started getting back down towards the mid-February or earlier levels in bond yields, that could slow down financials significantly and make me think a little bit more again about other sectors. So if this can create recovery and we start seeing bond yields rise, financials could be a star. The other thing that's going on right now is financials are generally reporting their earnings. As you can see, they've been fine. It's not explosively to the upside. It's not explosive to the downside. They're just fine. So priced in is how I would look at those earnings results. The final sector I want to talk about here is one that might surprise you because you probably don't look at it that much. And that's materials. And I say you probably don't look at it much. You might. I don't look at it that much. Materials are just an odd sector. So a couple of names that you might have heard of that are in materials that have been doing very well. We're talking about a move from 70 to mid 80s. So we're talking about almost 20% here in the last 5-6 months. Sherwin-Williams, Freeport-McMoRan, Dow Chemical, Newmont Mining, DuPont. It's like paint companies, chemical companies, metals. It's materials that we use for building infrastructure. These are necessary to expand the economy. It's kind of that idea, the same idea as investing in oil as a macroeconomic expansion play. So this has actually started to become a pretty interesting trade to me because it doesn't get as crazy overbought as some other sectors because people don't look at it as often. This is a great trending sector. I can draw in the trend now just to kind of make it clear, but really let's go since mid-February up. Remember, mid-February was really a consolidation point or a peak point for many sectors. Materials have just continued to just chime along, drive along, and every time you buy near the bottom of that trend channel, you get rewarded. So selling at the upper end, buying at the lower end, and just riding the trend, owning 3 to 5 month options here makes a lot of sense. So I'll be looking at a lot of these materials type names for my trends. potential breakouts if semiconductors can get high for my swing trades. Those oil names I think are incredibly explosive in terms of potential here. And, there's a lot in this market. And that's why I create a weekly watch list where I can look at what's going on with the swing trading candidates, what's going on with those trend trading candidates, and try to identify the winners before the market really piles into them. As I said before, feel free to contact me, keith@optionhotline.com. Call me 312-600-8004 if you have questions after the fact or after watching the replay. Keep an eye out for webinars on optionhotline.com to get that free giveaway. And please do ask any questions that you have right now. I am happy to address them. Or if they come up after the fact, you are always free to email me or call.
Okay, Keith, thank you very much.